and welcome to another episode of Open Banking Expo TV. This is the second in a series of 3 episodes in partnership with Experian. I'm Ellie Duncan, Head of Content here at Open Banking Expo and your host for today. And I'm delighted to be joined by Scott Hardiman, Managing Director of Software at Experian, and Conrad Ford, Chief Strategy Officer at Alaka Bank. Now, Scott and Conrad are here to discuss the acceleration of the digital onboarding process in light of the pandemic and the data and biometrics that are increasingly being used to create the ultimate seamless customer journey. Yet, the digital journey presents its own set of challenges around fraud and identity verification, which we'll also talk about, as well as the importance of being able to assess financial vulnerability in both consumers and businesses following a year of uncertainty and turbulence. Welcome both of you to Open Banking Expo TV. And Scott, I'm going to come to you first if I can, and let's find out a bit more about what your role at Experian entails, please.
Hi, good afternoon. Really pleased to be here first and foremost. So I'm the Managing Director of Experian's decisioning software business, which really means the software products that we build to help make better quality decisions. So really fall into 3 main buckets. Software products that help make lending decisions, customer management decisions, and then collections decisions. So I'd like to think that we're streamlining that process to make better quality, fairer, more accurate decisions for consumers.
Great. And Conrad, welcome to the TV episode. The same goes to you. We'd love to hear a bit more about your role at Alaka Bank.
Yeah, hi everyone. So I'm Conrad Ford. I'm the Chief Product and Strategy Officer at Alaka Bank. So on my remit covers strategy, product, and also marketing on the Bank Expo. So Alaka Bank is a new bank aimed at the SME segment, or what we call established SMEs. So there are many fintech challenges aimed at solving the needs of micro businesses, the 5 million very small businesses. But there's a very large, in fact, larger underserved segment of established SMEs, and Alaka is there to serve that segment. I'm also better known as a fintech founder in my previous life. So I previously founded a business called Funding Options, which is Europe's leading aggregator website for SME lending, and actually named as one of the FT's 1,000 fastest growing companies in Europe.
Great to have you with us, Conrad. And well, let's kick off the discussion. We've got plenty to talk about. So, obviously, no business could have predicted the pandemic, but I guess at the start of 2020, lots of lenders and credit agencies would have been sort of preparing or gearing up for perhaps something of an economic downturn, given that, we had Brexit and there were other kind of factors at play at the same time. So, Scott, starting with you, how did this enable you to sort of pivot the business so rapidly when it came to the kind of government-imposed lockdowns and the pandemic?
I think the first thing was getting the workforce overnight able to interact digitally, both internally and also with consumers. So I think certainly in our business, we've had the technology that's been available. There wasn't really the impetus to use it. So what you saw almost overnight is people having to interact digitally, their expectations being much greater, needing to be able to conduct business, to work with consumers, to work with clients, using the digital media that they perhaps hadn't before. So I think almost the overnight impact was one of need, and it was one of having to use the tools and the things that we had available at our fingertips. The second thing was, it's unprecedented is an overused word, but actually we'd not really experienced anything like it before. So we had to then use the data assets that we had available to us to be able to start to make sense of what we thought was going to come. So for us, it was a massive acceleration of a lot of the activities that were probably already in train. But the key to it was using the technology that was available, but also increasingly different and new data and analytics assets to really get a better handle on predictive power of trying to understand the future and trying to understand how we needed to pivot the business.
Mm-hmm. And Conrad, did you have a similar experience at Alaka Bank? And I know you talked about how it was a new bank. So how were you able to pivot?
Yeah, well, Alaka Bank had the strange experience that just as we were launching, COVID hit. So we pretty much launched the bank remotely, which maybe is the first time it's ever been done. Because Alaka had just got its license at the end of 2019 and just begun to enter the market as COVID hit. I think we obviously faced the expected operational challenges. Our sort of main lending product at the time was commercial property lending. Where there is an element of sort of physical interaction. You don't buy a premises without the kind of stuff you'd expect when you buy a house: surveys, legal documents, etc. So, overcoming the challenges of the kind of physical element of how the transactions are done was something faced by the entire industry. I think Alaka kind of had an advantage in that we didn't have a back book to worry about, which of course we haven't talked about. It was the existing lending was actually what was occupying the minds of existing lenders at that point in time. So yeah, moving to remote, which was helped by the fact that we've always been a cloud-based organisation. Because we're new, we were always built for the cloud, and of course, executing that remote strategy, working from home strategy, is dramatically easier when you're cloud-based, just because the infrastructure is kind of built with that work anywhere ethos in mind. The other big question that we faced at Alaka Bank was whether to take part in government lending schemes, where the kind of big theme, of course, from the spring of last year was effectively the lending market effectively froze, and then it reopened, and then some on steroids when government lending started. And actually, at Alaka Bank, we took the decision not to take part in those government schemes. And one of the interesting things, kind of untold stories of COVID, was that the government lending schemes were correctly focused on businesses that were struggling as a result of COVID. But there were, of course, a significant minority of businesses where it was actually the most active trading time in their history. Think remote, online businesses, healthcare businesses. And actually, they were largely ignored by the lending market. And Alaka was one of a very small number of lenders that were actively lending to growing, successful businesses at that point in time. So that was kind of our key input during COVID, was to sort of keep the lights on for the businesses that needed to grow and respond to COVID during those unprecedented times.
And staying with you, Conrad, perhaps you can explain how Alaka is creating a sort of truly digital, customer-centric approach for its marketplace.
Yeah, well, I think that the most interesting point around that is that we don't aim to be entirely digital, because the established SME segment, an element of human interaction is actually valued and on both sides of the transaction. So, for example, if you're lending to a medium-sized business, then typically there is an element of complexity, whether it's in the KYC and anti-money laundering checks, PSCs, ultimate beneficial owners, and all these complex concepts. There's legal entity structures, there's multiple directors. These things don't lend themselves to being purely digital. But more importantly, actually, the SMEs themselves actually value a human relationship. And in fact, 40% of SMEs in our target segment, the number one basis for choosing a bank is a relationship manager. So what we're trying to do at Alaka Bank is reimagine relationship banking, because there is a long-term secular trend of the incumbent banks walking away from relationship banking. So if you go back 10 or 20 years, then a business with a few million turnover in this country would have had a relationship manager in their local branch. These days, they don't have a relationship manager in the branch, and they probably don't have a branch either. And they've kind of gone from having an account manager in a call center, and now actually some of the big banks have even taken that away. You kind of get bounced around a call center, irritatingly trying to figure out how to solve your problem. So we're trying to reimagine that relationship banking with modern technology. So, what about if you don't need branches, expensive branches? What about if you can go to the client site, and get out an iPad and talk through their cash flow? So that's kind of the vision of Alaka Bank, is reimagining relationship banking with technology. Now that brings its own set of challenges, because we want our customers to be able to interact with us how they choose to. And if they're self-serving for a simple activity like making a payment, they don't want to talk to a human being. They want us to get out of the way. But if they're doing something meaningful like a lending transaction, they probably do want to speak to a human being. So for us, it's around offering a wide range of channels, some digital, some personal, and making sure that they coherently fit together. And that's kind of the technical challenge that gets me up every day.
Yeah, absolutely. And it's interesting to hear about that and how you're serving SMEs. I mean, as clients, whether those clients are consumers or SMEs, as you mentioned, as they become used to this kind of seamless digital onboarding process, which they increasingly are, of course, Scott, what do you think this means in terms of their expectations of sort of getting access to credit? So do they expect perhaps an immediacy that prior to the pandemic they didn't, perhaps?
Yeah, I mean, firstly, I fully agree with Conrad. It's about choosing and identifying the most appropriate channel. So, digital onboarding, digital client workflows are, I think, beneficial, but it's not the silver bullet that will solve all challenges. I think you've got to find the most appropriate depending on the transaction that you're looking to work with the client on. Certainly, client expectation, or consumer, I should say, expectation has changed. So it's differentiating slightly between commercial lending and consumer lending. I think the consumer immediacy is important, but actually, what you're starting to see is almost a value exchange that says, am I going to invest time and effort in a digital journey because I want to understand that I'm going to get an output? So I think what we've started to see is in prior years, it would have been a part digital journey and the consumer didn't get the outcome that they're expecting. It was just part of the process. What you're starting to see now is the consumer expectation is I will get an outcome. So I will apply for a mortgage and I'm expecting to get a mortgage in a very short space of time. I'm expecting to be able to verify, go through KYC checks, etc., via a digital process. You're starting to see more and more of that. But of course, going back to my previous point, it depends on the type of demographic that we're talking to. Certainly certain demographics still value picking the phone up and having a conversation with somebody. But I think what we're starting to see, and the pandemic has really accelerated this, is digital is now the norm. A lot of the demographic want an instant decision, and they trust that they'll get a digital decision. They don't see it as being a component part of a journey. So for me, a big element in this is trust. And we're starting to see that the digital channel is now becoming more trusted than it perhaps was previously.
Yeah, that's interesting. And Conrad, are you seeing the same among sort of SMEs, the same sort of need for that kind of instant access to credit, but also that trust?
Yeah, and I'd like to reinforce a really great point that was just made, which is that we find that established SMEs, generally speaking, they don't expect instant credit, and neither do they need it. A well-run business will rarely suddenly realise that it needs money in 2 hours' time. It can, of course, happen occasionally, but generally speaking, they will understand their cash flow and how that looks ahead, and they'll plan ahead and take a conservative approach. But the really important point is that it's around investing time, which is that to make an SME finance application, a significant application, will involve some elements of time and investment, producing management accounts, bank statements, etc. And of course, we can digitalize these things and make them easier, but fundamentally, they take a significant amount of time. What businesses really want to know is that investing that time is worthwhile. They don't mind investing the time. So it's around, how do you make sure that you give them that instant pre-qualification or instant, high confidence that it's actually worth investing time. So I kind of see this as a two-step journey. And I saw this as well when I was running funding options, that businesses want to know, is it worth me investing the time? So they want a tool where they can quickly get that answer with, let's say, a couple of minutes of investment of their time. And then they're happy to actually go through the more methodical steps of actually formally getting the offer and the due diligence. So I kind of see it as a two-step. What makes them incredibly frustrated, and we regularly see amongst the incumbents, is the inability to get any kind of answer. And often, from the business's perspective, they're waiting a month to get an answer. And then the answer they get back is, we need a more up-to-date set of accounts because the bank has spent a month sitting on the case. So it's the confidence to actually invest time and a lender that actually does what they say they're going to do is really what SMEs want.
Yeah, and actually, I was again staying with you, Conrad. Have you seen any change in the way that SMEs, in particular, sort of engage or interact with sort of financial services? Over the past year or so during the pandemic, or was there a kind of shift anyway that was already happening? Whereas, as you say, they were after kind of a relationship manager.
I think I think we've seen an acceleration of an existing trend. So I think we've all of us in the sector have spent a decade or so agonizing over the right channel mix for the SME segment. I think the right answer is now much more clear. Simple day-to-day transactional businesses, SMEs now want to self-serve. They want to go online and they want to get it done. And human beings get in the way. And indeed, human beings generally tell you that something's gone wrong. So humans are there to fix problems. So in other words, they want systems that get the job done and don't break. When they're doing something more involved, like a significant loan application, then they do want human beings, because they want human beings that are actually able to look beyond the simple yes/no of a computer, which is the computer says no is the classic complaint of an SME about their incumbent bank. So I think it's now clearer that there isn't a single answer about what SMEs want. It depends on the type of transaction. Is it day to day, or is it something that happens occasionally and has huge consequences for the business? So in that respect, it's been helpful. And I think COVID has accelerated it, because many businesses that were hesitant to adopt digital have now been forced to do it and actually realize it's better for those day-to-day activities. And another example I would give there is, once you've signed the contract electronically, you really never want to do a physical contract again. You actually get quite irritated. We all struggle with office printers. Well, they're a different league as your home printer. Yeah, you try printing and scanning 30 pages on your home printer. Which I've had to do, by the way, multiple times during COVID, and it's made me very angry. So I think what we have seen is forced adoption of some technologies has made SMEs realize that those technologies are really great things. They're not something to be scared about. They're something to be embraced. So we have seen an accelerated digitalization without doubt.
Yeah,
I think the other
I think you
piece
touched.
I think the other piece I just add to that is, I think, certainly from my standpoint, for both commercial and consumer lending, folks like to understand where something is in a process. So the most frustrating thing in the world is you completed step one, but you hadn't appreciated there were 4 other steps that needed to be completed. And I think digital workflow can actually make a big difference to at least making the person that's making the application aware of what's coming next. I think if you do that, then you can create still a great consumer or client experience. If you don't do that, even if it's a human or digital interaction, that's where I think trust and relationships start to break down.
And Scott, I want to come on to talk about sort of the biometrics, the data side of things here, because I'm wondering, how is automation and biometrics helping to ease the authentication part of the onboarding process, which I know has historically been kind of one of the biggest challenges, really, when it comes to verifying identity and making sure people are who they say they are, or businesses are who they say they are?
Yeah, I think biometrics, digital identity is a broad topic, and undoubtedly it helps in the digital process. So you can very rapidly identify somebody by a selfie or some other means. The issue, of course, is whether the person that's applying is comfortable to release that information. So it almost comes back to that value exchange. So for me to be comfortable to release my digital identity to you, one, I've got to trust you as an organisation. And 2, I've got to feel that doing so is going to give me the outcome I'm expecting in a probably faster period of time than it would otherwise do. So absolutely, it's a great means of getting to a decision quicker. I don't think the technology is a limiting factor. The technology has been available for a long time. I think what needs to change is kind of attitudes and the trust of giving that information to service providers to actually process it. I think the pandemic, as I mentioned before, I think that has started to change people's perceptions and people's views of digital media and digital ways of processing. But as much as anything, I see this as almost a cultural point that needs to be overcome rather than a technology point. So I genuinely think the technology has existed for a long time.
Okay. And Conrad, did you want to add anything on that and the role here that automation can play in sort of smoothing out that onboarding?
Yeah, I mean, I would just reinforce the point around it being around culture and acceptance and adoption is really the key point here. And I think what COVID has done is put individuals in situations where they have to use this technology and they kind of see why they have to use it. And I would say open banking is a good example, right? Once you've used it once, the next time you use it with another provider is far less scary. but I can completely see how someone who hasn't spent the last 5 years thinking about open banking it might be a really scary thing, right? If it's put in front of you the first time around. So I think there's an adoption point, which is COVID has kind of forced people to actually experiment with these technologies, because it's been the only way to get things done. If you think back to where the UK was a year ago, we were all quite scared as a nation, and we were barely able to leave our homes. So if you wanted to get anything done, you had to actually do it remotely and do it digitally. So I think, for the simple reason that once you've done it once, it's less scary. I think we probably have seen a real sustained uptick in adoption of these technologies.
Okay, and let's move on to talk about financial vulnerability, if we can, because the digital processing journey presents a bit of a challenge when it comes to identifying this kind of vulnerability. Yet, of course, now more than ever, it's critical to assess a consumer or an SME's credit risk, post-pandemic. So I was wondering, Scott, how can you overcome this hurdle? And in what way can the data available now provide a clearer, a more detailed sort of picture of a customer's affordability?
I mean, at one level, it does pose ethical questions in terms of identifying those that are financially vulnerable and making sure that you're presenting fair options. The data and the technology now enables us to put triggers in place that are indicators. That doesn't necessarily mean that somebody is financially vulnerable, but it's an indicator. For me, it's about presenting options to the consumer to make the right choice. It's not about the lender or the credit bureau kind of closing options down. It's about saying, actually, based upon previous spending patterns, based upon other factors, here's a range of possible outcomes. And then you empower the person that's making or applying for the credit or whatever it may be to make the right decision. But what the technology does is it gives greater awareness of what those different outcomes may be at the point of need. And that's where I kind of think that we need to be kind of taking these types of decisions or presenting these options much, much earlier in the credit life cycle. So you put the power into the hands of the person that's applying, as opposed to it being the other way around. But it's a really topical, I think, question. And actually, for me, it almost bleeds into the ethics around artificial intelligence, machine learning. It's the same type of topic. It's about making sure that we can present the information in the most logical way for the person that's applying for the product to then make an informed decision.
Okay, and I was just wondering then, what responsibility do lenders have when it comes to understanding how consumers and SMEs intend to use the credit they're applying for? I mean, you did kind of bring this up there, Scott, when you talked about the kind of ethical side of things. And really, I suppose, yes, I'm asking how involved can you get in that side of the lending process? Comrades, do you want to kick us off here?
Yeah, well, I think in terms of vulnerability, technology is a great enabler. So I think, as you framed the question, it was almost as if it gets in the way of supporting vulnerability. I think the opposite is true. Let me give a real example. If, for example, you're using open banking data, whether it's a consumer or an SME, you can use automated transaction categorization that will figure out how much of the expenditure that can be rapidly reduced, how much of that expenditure is potentially harmful, for example, gambling, and how much of the expenditure is overheads, whether it's property or utilities. So you can very quickly actually carry out analysis on behalf of the lending applicants or somebody with a live loan, and actually on their behalf actually support that assessment of vulnerability. In my world of SME lending, there is a huge amount of data publicly available about our SME customers, whether it's company's house information, their websites, whether it's VAT information. There's a ton of information available, and actually those can be used as forward indicators of potential vulnerability. So what we're trying to do at Alaka, and what I spend a lot of my time on, is actually using those data sources to make sure that we're lending responsibly. Because of course, it's a win-win for us. We don't want to lend to people who can't, businesses that can't pay back. and we certainly don't enjoy collecting on loans in that situation. So, for us, technology is a great enabler of actually getting affordability and vulnerability dramatically better than it has been in the past.
Mm-hmm. Thanks, Conrad. Scott, do you want to add to that?
I think only to almost re-emphasize or reinforce the point that we have a huge amount of analytical power at our fingertips now. Generally speaking, the more data, if you can understand that data using analytics, you can get to predictive indicators. It's then how you deploy and you use those predictive indicators to make fair decisions. I think that's the piece that I think will start to define that ethical question that you pose. It's about how the data and how the analytics are used to make fairer decisions, which I think we are, as an industry, we're absolutely kind of committed to making sure that we do that. But as we said before, adoption can be quite challenging. Something which is new, the fear of sharing data to make a fairer outcome or to get to a fairer outcome can be quite challenging, and it's going to take us a period of time for us to get to that end state. But I'm a firm believer that the more data that we can share, the better and fairer decisions that we can make.
Yeah, well, Scott and Conrad, thank you so much. That's all we have time for today, but thank you for joining this episode of Open Banking Expo TV. Good to hear from you both. And for those that are watching, thank you very much. You could see the first episode in this 3-part series by going to openbankingexpo.com and visiting the on-demand section. Goodbye for now.